Hey everyone, welcome to the KE Report in a daily editorial on Veterans Day or Remembrance Day, whether you're living in the US or Canada. Hope that everybody is having a day off if you get it, or at least a slower day at work. It is November 11th, and we are chatting with Jim Tassoni. Jim is the CEO of Armor Wealth Strategies. Jim is our momentum trader. So we talk to Jim every month and see where the momentum is, what sector he is playing, and Jim, right now, it seems like broadly markets, metals, a lot of different sectors are in a bit of a corrective or pause phase right now after a lot has had a very good year so far. Maybe it's just the end of the year trading or really that correction that a lot of people are waiting for and calling. Well, curious what you're seeing out there, Jim. Any momentum that you're playing? Any good areas of opportunity for investors?
Yeah, thanks, Corey. And I just want to echo your sentiments and just give a quick thank you to all the veterans, both here and over the border in Canada, for their sacrifices and their families' sacrifices. It does not go unnoticed or unappreciated. But with that being said, transitioning back to the markets, yeah, this is a situation and this is how markets move. So it's not to be unexpected. We have periods of trends, whether they be up or down, usually followed by periods of consolidation. And I would categorize what's going on right now, at least in the equity markets, as more of a consolidation than an outright correction. I mean, we're not really that far off of all-time highs here as we speak today. I think we've got to pause. Whether or not it turns into a correction is anyone's guess, but I think that's why I prefer to trade with levels. We've talked about this before on the show. I like to know my out before I even get into a trade. I know where I'm getting out. I know where I may or may not be taking profits. I'm watching to raise my stops, trail and trim, trim and trail, however you want to put it. But I think the key for investors and traders alike, as volatility picks up, things maybe get a little bit more choppy, is to have those levels, have those positions, know where your trade is invalidated. Whether you're a day trader, a swing trader, a long-term investor, have your thesis and know what invalidates that thesis and abide by those rules. Because the way I trade, I look at it, I take a lot of small losses in markets like this, but I can always re-enter a trade and look for that trend to continue. And I don't need to be right in every trade, because when I am right, my right trades are so much bigger than my wrong ones that it makes up for the difference. So that would be kind of how I'm approaching this market right now. Now, as far as trends go, we continue to not be stopped out of our long equity positions. So we continue to be long equities as a whole, tending to favor more of the risk type of assets in the equity market, the higher beta names, higher beta sectors, shorting or avoiding kind of the safer staples type markets. So we continue to have that trade on. And even though we've seen a little bit of a pullback in the last few weeks, that trade actually continues to work for us, kind of long, high beta, short, low volatility. So will it reverse? Again, we don't have to play the game of guessing whether it does or not. We know our levels will book profits when and if those levels get breached.
Well, Jim, that's a nice summary, and it's also some good strategy that you're providing listeners here today. Maybe we could dig in a little bit further with some examples. Let's maybe pivot over to something like gold and GDX. It's had a pullback, kind of similar to the markets, but a couple weeks ago it was at a all-time high in mid-October, and we've seen something like GDX correct down pretty hard, about twice the amount that gold has. How do your levels work in that scenario? Do you have any spots that you would be a buyer on pullbacks? Do you have any spots that you would exit on a long position? Maybe put some color around that.
Yeah, so GDX is an interesting one, and this has been a trade that's obviously been a monster for us this year, and for anybody really who's been involved in this position. So the way we like to trade, and this is how we trade all markets, irregardless of what they are, whether they're a commodity, an equity, a bond, so on and so forth, is we look for longer term trends to identify sort of the direction that we want to trade in. So if we've got a bullish trend going on our longer term charts, we're going to look for areas to enter long trades, and we're probably going to be either long or flat if our shorter term levels are indicating that that the momentum has been lost in this trade. So, and that's what actually happened for us in GDX back on October 23rd. On October 23rd, our levels indicated that we had breached our level at that point, and so we went to the sidelines. We sat that trade out, and we actually haven't been in GDX. We just were flat that position until actually today. Today signaled a what we believe to be we got back above. So we look for sort of a consolidation and then a momentum trade to continue. And for us, that level was 73.65. And when we opened up above that yesterday and closed above it, for us, that indicated a resumption at least, or a potential resumption in the trend. So we actually bought on the open today. We reestablished a position in GDX. Now, it's at our minimum size right now because the trend is not showing super bullish tendency. We're still kind of trending a little bit down on our shorter term levels, but we did get in right now. I mean, we're down a little off the open, but we're going to lean against that 73.65 level as a stop. If we can stay above that on a closing basis, we'll continue to be long of GDX at this point.
So, Jim, just curious what it would take for you to add to that position. It sounds like, again, you said a very small position, kind of like a starter position again. What does GDX have to do for you to build and get more confident with that?
Yeah, I think I would need to see, if we trade it back down to 73.65, I like to see reactions at certain levels. Because we gapped above it. So we haven't really tested that level yet. There's a potential of a gap fill, and I'm aware of that when I'm getting into trades. If we do end up trading down to that 73.65 level and held it and closed above, for me, that would be a bullish signal and probably a place where I'd want to add to the position. That also being said, if we get into a situation right now, I'm looking at a pretty key level right around $81 as potential resistance. If we can get up to that level and close above it, I think that shows a resumption in a stronger trend, and I would be adding there as well. So there's an opportunity sort of to add on a pullback and a hold above resistance, or excuse me, above support. And then there's also an opportunity to add on momentum if we can climb above that $81 level that I see as resistance.
Well, Jim, just sticking with the same chart with GDX, just because it helps get the concepts out there, there was a gap down that's actually getting filled by this price action right now, even though we just had a gap up. So when there's multiple gaps like that, you're coming up with some different targets. I think it'd be helpful to figure out how you generate your targets. Are you looking at Fibonacci extensions? Are you looking at trend lines? Are you looking at lateral price support? Are you looking at moving averages? How do you come up with your targets?
Yeah, so my levels are established mainly by volume area profiles and market profiles. So what I really like to look at is volume area. And so I look at areas where there's been a lot of volume traded at a certain price. And I actually have an algorithm built that will identify those areas and then mark them as key levels that prices traded down to or traded up to multiple times with heavy volume. And that for me will establish areas of support, areas of resistance, and then sort of in the middle is the heaviest areas of volume, which I consider sort of like pivot levels, which again is an area where if we're above I like to try to look for longs. And if we're below, I'm probably going to look for shorts. And so my shorter term trades are volume areas on the daily chart. So that's where I identify kind of the entries, whether they be, above a certain resistance level or a support level, etc. On my trend indicators are drawn from weekly charts. So that's when I take a step back, sort of zoom out and say, on a longer term basis, what does this trend look like? And that's how I sort of get my bias to either trade long or short.
So, Jim, if we're still talking metals, fine, you have a small position in GDX. Anywhere else in the metals or resource sector that you're either long or short?
Yeah, so we're still maintaining sort of our long bias, long exposure across the majority of the metals markets. We're still long gold, we're still long silver. We've actually added a few positions, and again, we don't when we're in these type of positions, we don't go huge, but we've added positions in platinum and palladium too, which are interesting markets to be trading. But we think overall. We believe that the commodities markets still have room to go on the upside. The trends are still there. And we see this consolidation as an opportunity to take maybe a lower risk trade. Also, understanding though that signal strength, momentum strength isn't as strong as it was. So that's why we're taking smaller positions with them. But we're still long gold. We're long silver. We're long the silver miners versus SIL via SIL, long copper. And then on the short side, as you probably could expect, and it's worked well for us the majority of the year. Kind of again some more chop in here, but we're short crude oil, so that's kind of our short in that space.
Yeah, it makes sense to have been short crude oil. It's not been a great year for that or nat gas, really. But just pivoting back to copper, it's a pretty big disconnect between what the copper price has done and what the copper producers have done in the COPX ETF, or you could look at ICOP, same kind of pattern. So, what do you make of the strength that we've seen in the copper producers? Well, I guess copper has been strong because it's hanging out around $5 a pound, which is pretty strong price, but the producers have far outperformed the metal in this case.
Yeah, and I think if you're looking at that, and we unfortunately, I think we may have talked about this last time, how we missed the trade on COPX. So that is one that I wish we had the opportunity to participate in. We did not. Unfortunately, I wish I had, unlimited capital, but there's only so much capital for so many trades, and so we did not participate in that move, but. I think you've got, you had a depressed sector, a depressed group of stocks that, as the metal, copper in general, started to stabilize and move higher. I think you sort of had this, this almost leveraged play to the upside in this COPX ETF. And I think that led to a lot of the outperformance. I mean, similar to what you saw probably earlier this year in GDX or SIL. When these metals start to get going, you can get significant upside outperformance from the miners. But as we all know, and you guys probably actually know better than me, you can also get it going the other way too when these things start to break down.
Very true, and that's kind of what we're trying to figure out right now is if there another leg is coming much higher, if there is another leg down. Let's get out of the commodities, Jim, because you're right. We chatted a lot about those last month. What else out there? It's a big world of financial assets. So, what are you trading? Give us some more trades, please.
Yeah, so kind of shifting back to the equity markets, one area, and I know I mentioned, being looking for higher beta sectors and kind of more of those MOMO, which makes you think tech, quantum stocks, all those kind of things. And we have been long those and been long those fairly successfully since, the May timeframe. The one area that we got long mid-September that was a little bit contrarian, but we saw the momentum start to pick up and the trends start to pick up is the healthcare sector, whether it's via XLV or any of your other healthcare ETFs. We particularly use XLV in our portfolios. And that's been one that we identified and have been in since mid-September. And it's been a great performer for us, especially in contrast to our short in XLP, the consumer staples ETF. So not that we set that up purposely as a pairs trade, but again, I think you're able to find nuance and sector strength and weakness, even in what's been more of a consolidating sideways market to take advantage of. And long XLV, short XLP is just one of those particular areas.
It almost does make an interesting pair trade, though. And like you say, you've been high beta but short, low volatility. Maybe when you're doing the short side of things, we don't talk to people that short the markets as often or short a sector. Are you using options? Are you using inverse ETFs? How do you go about the short position?
So for me, I have the ability to just outright short these ETFs. And certainly, again, you have to be careful with this because certain ETFs like XLP or any really of the sector ETFs, the spider sector ETFs, the volume there, the borrow is readily available. It's a very wide and thick and liquid market. So that you're really safe on. Now, if you're trying to short some of the lesser traded ETFs, I would be very careful. But for these, we're able to get a very easy borrow. It's a low cost, and so we're just outright short. In the case of XLP.
Jim, we're nearing the end of the year here. We only have about a month and a half left of trading, and I think we can all agree that it's been a good year for anybody invested in these markets in a wide range of different sectors. Does that change your trading strategy at all as we approach the end of the year?
You're tempted to, I think, but for me, I am a slave to my trading process, my trading style, and my trading philosophy. And the reason I do that is because I have the battle scars of trying to think that I'm smarter than the market or wanting to make tweaks or changes. And so it's a situation where we've had a really good year this year. We had a really good start to the year, fumbled a little bit in April and the first little bit of May. And then we got our trades in the right direction and we've had a really strong last 6 months. So it's very tempting to sort of, I guess, coast into the end of the year. But if we do that, we're doing not only a disservice to my own personal trading account, but to the clients that we have invested in and manage money for as well. Because the way we trade is sort of liberating because I don't have to worry about trying to guess or figure out where I think the market's going to go. I let the price action tell me. And so there could be opportunities the rest of the year, or we could chop and flop around till the end of the year. But I know that my style, my strategy, my levels are going to identify it. And I would feel terrible if I mailed it in for the rest of the year and we had some type of explosive event in December that we were really able to take advantage of. And we know that we've had those in the past. I mean, it was only a few years ago that we had that, what they call it, red December or whatever it was. And we did really well for our clients in that situation too. So we're going to keep doing what we're doing, irregardless of where the calendar's at, and let the price action dictate our strategy.
Fair enough. I appreciate that, Jim. That's why we're going to be chatting with you next month as well, because there are always opportunities in these markets. They seem to usually be on the long side, but we are still waiting for some sort of more meaningful correction in a lot of markets where I guess you can make money on that short side. And there's still those bears out there calling for a major correction. We'll see if that comes later this year, next year, when it could come. Again, Jim Tassoni, CEO of Armor Wealth Strategies. Click that link in the show notes to visit the Armor Wealth Strategies website and follow along with Jim. Jim, thanks for your time today.
Thanks.